Okay, folks, welcome to the Contrarian Trader. This is Robert Desmond. I am posting this. This is my first blog on Invoost.com, a great educational website for those who are new traders, do not want to put new money to work in the market. They want to paper trade, or if you have some experience and you're looking to build your skills. I mean, there's nothing better than to compete against other people who may or may not have your skill set, yet you have no capital at risk. Invoost, the people over there are fantastic. It's just a great company. If you're looking for a place to learn how to trade, this is it. These people are building up in Silicon Valley. They are looking for the best talent. They've invited me to join in as one of their VIP traders. I'm happy to do so. It's because it's what I do. It's the reason why I started the Contrarian Trader. So, however I can help you learn to trade, please let me know. Send me an email. I have an inbox on Invoost, or you can email me, robert@thecontrariantrader.com. I'll be more than happy to answer any of your questions that you might have, even on this video. Before I get over to the chart, about me really quick. I've been trading stocks for over 25 years now. My specialty is long short. I'll trade any market. I use technical analysis and I use macroeconomic data. And I don't mean just United States macroeconomic data. I'm talking about global economic data to help me with my trading. And I do not day trade that much. I am more of a swing trader to a long-term trader, meaning swing trading several days to several weeks for any one position. I trade around usually a larger core position. Right now, I am shorting the overall markets using instruments such as the TZA. I am bearish on the overall markets. I'm going to get to that in a moment. However, you could still make money to the long side even though you're short, because some of the issues that you run into as a short is the main thing is that the markets always want to go up. The system is rigged against you. The key is to learn that you must appreciate the fact that the system is rigged against you. Why? It's because CNBC sells less advertising in a declining market. That's a fact. You have 70% of hedge fund managers who run the market. They're unable to short stocks. They can either A, have a percentage of money in cash, or B, be long. The fact that they need to be long of the overall market means that it's in their best interest to go on CNBC, compel you to go in and buy. They don't care how high the market is, how extended it is, whether or not the earnings are declining. They don't care. They just want you, the small investor, to come in so they can sell to you and keep the market going. So please, I beg of you, watch the rest of this video. Take a look at my charts. They have theirs, I have mine, and I'd like to express to you how it's so critical to learn how to trade this market using contrarian investing. Let's move on. Let me show you. Before that, let's just take a look at Invoost. This may be going out to my Twitter followers and to my StockTwits followers, both great services. So, if you're not already a member of Invoost, please go over to Invoost.com, sign up. It's free, doesn't cost you a dime, and hone your trading skill. That's what it's all about. It's a great trading tool, and plus you can win cash prizes. As a matter of fact, I think they have a contest coming up. I just got an email. Here it is. I haven't even closed out yet. The Big Bang with $1,000 in cash prizes at Invoost. That's great. That's a great deal. So, and they're coming out with a mobile app as well. Great people. Please sign up. All right, let's get over to my charts. This is what I look at. This is part of the macroeconomic pulse check that you need to take on the market before you trade. How is the real economic growth in the United States of America and the global health of the global economy? You need to know that before you get long or short. So let's just take a look at last week's economic data. Durable goods. This is where the rubber meets the road. Durable goods. Market expectation of a decline of 3.1%. Now stop and think. You have people out there that go on CNBC every single day. They pound the table that we're going to see 4 or 5% real growth in this economy this year. If somebody could please copy me in on the email that says that we are going to get to that growth rate when you see durable goods orders. Durable goods meaning washing machines. Anything that lasts for 5, 10 years, that's a durable good. So your stoves, your refrigerators, anything that's to do with housing, appliances, that's durable goods. So market expectation of 3.1% negative number. We came out with a negative 5.7%. 70% of the U.S. global economy is based upon consumption. 70% of the U.S. economy is based on consumption. How are you going to get to that type of growth rate when you have durable goods which are declining? It's not going to happen. Let's move on. We'll skip over initial jobs claims. GDP. Market expectation, 2.8% growth. Now remember, Q4 of 2012, it came in negative initially. After all the revisions, it came in with a slight beat. This number here is subject to revision, and it missed. There'll be 3 or 4 more revisions of this number. It missed expectation, market expectation of 2.8% versus 2.5%. You had money managers on CNBC last week saying that in the second half of 2013, you're going to see 10% earnings growth. I'm going to get to a chart in a moment to just to show you how ridiculous that is. That being said, let's get beyond it. GDP came in with a miss of 0.3%. Guarantee you, the revisions will be lower. Okay, the last economic data point from last week was the Michigan Sentiment Survey. Basically, consumer confidence. How well is the U.S. Consumer feeling? Well, according to the durable goods orders, they're not feeling that good, right? We covered that a little bit earlier. So, Michigan Sentiment Survey. How is the consumer feeling? Now, here's where the media plays games with you. You have a market expectation of 72.4. The actual came in at 76.4. That's a beat. Now, let me show you why you should not get excited over that number. What you're looking at here is obviously a chart of the University of Michigan Consumer Confidence Index, the Michigan Sentiment Survey. The first thing that jumps out at me is that when I take a look at this line chart here, what I see is a setup for a head and shoulders formation. Again, a head and shoulders formation. You can see it on stock charts. You can see it on economic indicators. You can see it on indexes. What it is, it's showing that the market had projected itself higher, pulled back, healthy pullback, rallied to make a new high, pulled back, held the previous low, rallied, and is now struggling to break out to a new high. All of this is okay up until here. Now, there's something called the neckline, which is right here, right below these 2 points. If the Michigan Sentiment Survey breaks down next month below this neckline, you had better be short of stocks because this market is going down. CNBC will not put this chart up. All they will do is do this. The market expected 72.4. Wow! Let's take it over to Steve Leishman to tell you how great this number is at 76.4. And the futures rally. Get everybody excited. But this is what you should be looking at. You need to go to websites like InBoost for their blog and their forums telling you what's really going on. You need to go to zerohedge.com to get charts like this. My mentor, Doug Cass, one of the greatest investors alive today, he swears by this website, zerohedge.com. Great website. And just to get back to the report that was announced last week on Michigan Sentiment Survey, they expected 72.4. I came in 76.4. Why am I not excited about that? Here's the prior month right here. Look at where we came in at last month. We're trending down. We're trending down. It's not good. Not for an economy that is based on consumption and services. Let's move on. This chart here is a percentage of our debt to GDP. They want you to ignore this. They do not want you to take a look at this chart. They want you to buy stocks. because the Federal Reserve is artificially manipulating the economy. Our debt to GDP is now at 104.8, rounded up 105%. We're bankrupt. That's bankruptcy. And this is ever since 1/20/2009. Now, this is a pretty short chart in terms of time frame. Don't get me wrong, folks. I'm a fiscal conservative. I think George Bush did a horrible job with the economy. Barack Obama is just horrible. This is since he's been in office. The chart preceding this of the prior years of the Bush administration are less worse, but bad. So let's not get into politics here. Our government officials are not serving us in Washington. They must go. All of them. They must clean house in Washington. They are corrupt. Let's move on to my next chart. This is what you call your underemployment rate. What they want you to hear every week is called the U3 number, or every month. And it tells you the unemployment rate. And every month they try to take it down a little bit. But what they do is, the only reason why they are able to tick it down is because they start to exclude people who are now working part-time, those people who aren't looking for a job at all. So how do you account for those people who are underemployed so you can get a really big picture of what's going on in the economy? Well, you have the U3, which is reported every month. That's what the media takes. They love to take it down. The economy is great. Maria Bartiromo chit-chats at the end of the day with Bob Pisani. They set you up for the following day, get you all excited to buy stocks, when you should be looking at the U6 number. The U6 takes into consideration the underemployed. The real underemployed or unemployment rate in this country is over 14%. That's a fact. I don't make that up. If you want the chart, email me. I'll send you the link to the chart to the U6 number. Robert@thecontrariantrader.com. Let's move on. Oh, by the way, the only reason why I brought up this chart is due to the fact that it's global. These are the underemployed here in red. This is what's reported to the people as the unemployment rate. Okay? This is the real unemployment rate. In red are the underemployed. The real is up here. U.S. is 15%. They rounded it up. This is the real number, folks. This is the world that we're living in right now. You want to know why gold is dropping like a rock? It's because of deflation. That's why the Federal Reserve will not take the pedal off the metal, and they will keep rates low. They must, because if they didn't, this economy would fall apart tomorrow. Let's move on. Divergences. Divergences are important. What's a divergence? Well, traditionally, let's use this chart here. This is the S&P 500, highlighted in black. You have commodities highlighted in red. In a global economy, you want to see commodities, steel, oil, anything that helps to build things, copper. You want to see them rally together because it's a confirmation of the underlying health of why the S&P 500 is rallying. However, back on January 1st, it's funny how all these divergences occur on January 1st. I already went into this with my members. On January 1st, the divergences started to occur, and commodities fell out of bed. Think about the drop in gold prices recently. And the S&P 500, for some odd reason, continued higher. Why? Why is that? I'll get to it in a moment. The S&P 500 versus, highlighted in black, versus the 10-year yield. Ideally, the United States economy, and this is what befuddles a lot of people, the United States economy does best when yields are rising. That's right, I'll repeat that. The U.S. economy does best when yields are rising. Why? It's because there's a demand for money. There's a demand for goods. Consumption is truly organic and healthy, and the Federal Reserve at some point has to step in and say, wow, it's getting a little bit too hot, inflation's getting out of control. You know what? We got to tap on the brakes here, raise rates a little bit higher, but the market will still keep going higher. We're not seeing that right now. They traditionally trade in tandem yields. People don't know that. That's why I'm here. This is what I teach my members. S&P 500 has been trending higher while rates and yields are going lower. That's a divergence. Yet what do you hear on CNBC every day? buy stocks. We're going higher, folks. Percentage of companies beating earnings estimates. Traditionally, it's about 47%. Now think about that. How does that happen? That you have an analyst that works for Goldman Sachs, an analyst that works for J.P. Morgan Chase, name your company, the name brand, brokerage houses, banks. How do they miss almost 50% of the time the earnings estimates? These guys make over $150,000 a year to cover one sector. How does that happen? It's because what they do is, it's all part of the game. They underestimate. So that when these companies come out and they report earnings, they beat. And what does that do? You wake up, Dow beat on earnings today. Wow, the futures soar. Everybody gets excited, and you have Joe Kernan, and you have the other broad, and the other guy. Oh, God, Steve Leisman. How did this happen? Oh, gee, it was the greatest earnings report that they expected. The one question they should be asking is, how does it compare to last year? They don't talk about that. I'm going to get to another chart in a moment. Let's move forward. Okay, next chart. Percent of companies beating revenue estimates. Again, I sent this out last week. Remember, that since I sent these charts out, these past two charts out, you've had 1/3 of the S&P 500 come out and report earnings in 1 week alone. That was last week. It was roughly 28% the prior week. So the common theme that you still heard last week is that the beat on earnings, missed on revenue. These companies can only cut costs so close to the bone. You need organic growth to get earnings per share moving forward higher. So when you take a look at the percentage of companies beating on revenues, it's a great illustration of just how poorly our companies are doing. This is the S&P 500. Traditionally, roughly 38% of the companies beat on revenues. Again, $150,000 plus bonuses at a minimum. They're making these analysts on Wall Street. How do they miss revenues 38% of the time? They do it on purpose. They want to lowball the number so these companies can beat. The market gets spiked by the young and dumb trader that goes out there, or as they like to call the individual investor, dumb money. It's not my phrase. I don't use it. They do. That's how they consider us. Dumb money, the individual investor. So you can see that this quarter, Q1 2013, doing horribly. Not a good quarter at all. So revenues, earnings, not doing well. Take a look now. This is the most important chart. This is the earnings per share for the S&P 500 since 3/31/11 to present. This is real time. And this is what CNBC should be reporting, not the company beat expectations, which were lowballed to begin with, manipulated. They should be saying that earnings per share are declining. Year-over-year growth is declining. Year-over-year revenue is declining. Year-over-year earnings per share are declining. Larry Kudlow says that earnings are the mother's milk of the stock market. He's right. If that's the case, how can you have a precipitous drop in earnings, yet all of these fancy pants, multi-million-dollar per year compensated talking heads get on CNBC and say, buy stocks here? Okay, as you keep these earnings per share in your mind, let's move on to the next chart, which is the S&P 500 on a monthly basis. It goes back to 1993. In candlestick here is the S&P 500 overlaid in gold. You have gold. In red, you have the banks. In green, you have the U.S. dollar. And you can see that we've broken out on a monthly basis with 2 trading days left in the month to an all-time high on the S&P 500. Back in 2007, I called for a super cycle double top. Back here, we got it, and we rolled over into the financial crisis. We made a great deal of money on this move down. We didn't get out down here on our shorts. We got out about here, but we still made a great deal of money. So here we are once again. We're back up at the top. Earnings per share, like this. Not good. Revenues, beating horribly. The question then becomes, where to from here? We're shorting the market. IWM, one of our biggest shorts. You can see on a daily chart It's not confirming the move higher on the S&P 500. It's now beginning to peter out even further at this downtrend line. So we're going to be looking to add to shorts in the IWM. If you're not currently a member of the Contrarian Trader, please join up for the 14-day free trial. You'll get Sundays, the week ahead commentary, plus my stock trade alerts, videos, etc. on what we're going to do, how we're going to trade this market, and why we think it's going to go down. That could all change. That's why you need to stay in contact with me. Be on my mailing list. I'll send you out the best charts, info that I have at my disposal, and I look to help you make money. In the meantime, you're new to the stock market, there's no reason why you can't take advantage of a 14-day free trial offer and use it as you're trading on Inboost. Inboost is a great company. Use it. You can't lose money on it. Use it as a trading tool. And please, sign up for my 14-day free trial offer. No strings attached. The minute you sign up, you get access to my holdings and my watch list and my videos. Look forward to providing you more information on Inboost, Twitter, and stock twits in the future. Have a great trading week, folks. Be careful. And if you have any questions, please shoot me an email, robert@thecontrariantrader.com. Take care. Bye-bye.